Hello gang, welcome to another video. As you can see, the topic today is Warren Buffett is raising cash and the market and missing out on the booming market. I was having a conversation with some friends and they didn't grasp or comprehend the fact that the market isn't always a nice and friendly investment vehicle. Sometimes the road can be bumpy. And they didn't believe me, and it was very hard to explain and convince them that they should be cautious and be selective in their investments. And I've read a bunch of Warren Buffett's books, Intelligent Investor, and what I've come to realize is that Warren Buffett won't tell you to sell or that fear and panic will come in the market. But when you read about his actions, he very much tries to avoid risk. He very much raises cash when he's not sure there's a good value in the market. And he will deploy cash when there's bargains. Unfortunately, in order for an expensive market to become a bargain, it has to sell off. And speaking of which, let's look at the market. And I don't know if you're aware, but for someone like me who watches the market all the time, the market is still near all-time highs. It has been selling off for a few days, but look at this chart. This is just the S&P 500. Now, you may not think you're in the S&P 500, but if you have a regular retirement account, odds are you have a bunch of this stuff in your accounts. And I could mess with this chart and make it look less scary or more scary, but we haven't had a real sell-off in a long time. We even in 22, from 2021 to 2022, that was a 30% decline. A lot of people complained, but it wasn't that drastic, especially not after the huge recovery that we had after that. All right, well, what is Warren Buffett doing? Well, let's see. When you pull up the cash, Berkshire Hathaway's cash pile, he raises it. He raises it when he doesn't find a lot of value in the market and when he's a little more fearful. In the book that I have on his life and his trading actions, before the crash of 1987, he had sold all his portfolio except for 3 stocks. And a few times in the 70s, he didn't think there was a lot of value, so he reduced his positions. But when the market sells off and he finds bargains, he's loading up like crazy. He even got rid of his partnerships in the 60s only to create Berkshire, the hedge fund, the partnership vehicle, his mutual fund almost, Berkshire Hathaway. Let's look at this other slide here. Warren Buffett has a huge amount of cash right now. This is as of May 2024. And notice that spike, the biggest spike he's ever had. It's also, Berkshire is also the biggest it's ever been. But we can look at the number. If we go to Seeking Alpha, we can get the latest information that has been reported. And this is September 2024. Huge cash pile, the biggest cash pile they've ever had. So what is he saying by this action? I believe he's saying that, hey, the market isn't that attractive at these levels, that he believes he'll get a better bargain. Some people like to say, like, it doesn't matter when you buy the market. You'll be okay historically in the long run, especially if you're investing for 20 years or 10 years. And while that is correct, it can be very painful. Imagine buying at one of these tops and not making any money. Maybe you'll make a little bit on the dividends, but realistically, you don't make any money for 7 years. If you bought in if you bought and didn't care about the price and you bought at the top in 2000, you didn't make any money for 7 years, and then you lost to inflation. Same thing if you bought at the top in 2008. How long did that take? That took 5 years. There's 5 years of not making money. So you lose opportunity, but then also you miss out on being able to buy it 50% lower, because most people who buy the S&P, they're going to make about 7% a year, sometimes a little more, sometimes a little less. But if you buy at bad times and then it declines only to come back to where you bought it, that's not very attractive. If you can wait for a dip, which everybody wants to buy for a dip, but when the dip comes, sometimes they're too scared to. If you can buy in the dip, you can make 100% very, very quickly as the economy recovers. Normally, to make a double or 100% return in the S&P, you might have to wait 7 to 10 years. So that's a big difference from making no money for 5 years or 7 years, or waiting 7 years to double your money. You can get a huge return if there were to be a recession. So I point that out because Warren Buffett, who everybody loves and looks up to, that's what he practices. When he sees a market like this, he's raising cash. Clearly, he's raising cash. It's publicly available information. So I actually did some back testing on this. If you waited for the market to be just near the average, so I was using the 200-day moving average. If you just waited to buy below the 200-day moving average, you would get 3 times more return than if you paid 20% above the moving average. So what are we right now? We're 10% above the moving average. So I was using 20% above. If you invested when the market is significantly above the 200-day moving average, you would make 4% or less total return for 10 years, I believe. But if you waited for the market to sell off 20% below the 200-day moving average, you can get something along the lines of 12% per year. So that's 3 times more money. And that's what investors are looking to do. So I'm going to leave it there. Every once in a while, I'll pull up one of the books on Warren Buffett and his investment track record. But if you are a fan of value investing, if you're a fan of Warren Buffett, do as Warren Buffett and wait. Warren Buffett will wait as long as 2 years without doing anything until he finds the right pitch to swing. So not advice, but in my opinion, I think people should be selective. There are values here and there, but overall, the market is up, people are greedy, and the values are very thin. So thumbs up the video if you agree, and if not, let us know why in the comments. Cheers.